Good morning or afternoon, everyone, and welcome to the Accounting Update webinar presented by Hein Associates. I'm Shannon Reddy, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A. The webinar is being recorded. Links to the webinar slides and recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive CPE certificate for the course. Our presenter today is Jake Fossen, Audit Partner and National Director of Audit and Accounting. Jake provides a wide range of auditing, financial reporting, and consulting services to both public and private companies. He specializes in securities and exchange reporting. He has significant experience helping clients with due diligence and initial public offerings, private placements, and mergers and acquisitions. He has worked extensively with companies in the oil and gas industry, as well as with companies in technology and real estate industries. We will have our first polling question now. What is your current role / type of organization you work in? Please select from the below. In public accounting, a controller or financial reporting role, or in government or academic community, or other.
Okay, everybody. Good morning. This is Jake Fossen. I'm happy to be speaking with you today. I am set up my presentation here to go through the accounting update for 2016 and things that may impact us coming into 2017. Kind of organized it in a way in which I've gone with the most recent accounting pronouncements that have come out, working our way backwards, with the exception of leases and revenue. And obviously those are two major standards that have come out. And those two standards could take a lot of time to teach a class on them. So we'll hit those in the end, kind of the highlights of them, the major components of the revenue and the leases. But really we're going to focus our attention on the other standards that have come out and allow for longer sessions and other CPE to cover the leases and the revenues. And at any time, if anyone has any questions, type the question into the dialog box there, and I'll be happy to answer those questions. And interaction is really nice. I appreciate any kind of questions or comments. The first new standard that has come out was ASU 2017-01. It only came out a week or two ago, and you'll see a lot of common themes on the recent ASUs other than the leases and the revenues. And the common theme among a lot of these is an effort by the FASB to make the application of GAAP easier to do and less complicated. So I actually appreciate most of these pronouncements that have come out, because I do think they will be making it a little bit easier on us auditors and preparers. And this first one is right along with that theme. The definition of a business was pretty broad, and I think it was broader than what they intended to. And as long as I've been working in accounting, there's always kind of been a debate of how do you classify what is an asset versus what is a business. And obviously the accounting implications could be vary greatly, because one, you're using a cost-based method to account for an asset acquisition, and the other is at fair value. And obviously a cost basis is a lot easier to apply than a fair value basis is. So they've decided to add a screen that we can to look at to determine if a set of assets is a business. And what they are trying to look at is, say, if you have a single asset or a group of similar identifiable assets, then it's not a business. The old analogy that was described when FAS 141R first came out was a completed apartment building with no tenants in it. Standalone building, there's nobody in it. It would contain the asset, and it would have the ability to generate an output if inputs were added. And so that single, apartment building or office building with no tenants could be considered a business because it had the ability to generate an output. Similar in oil and gas, if you acquired a field, it had inputs, a process, and an output, and was considered a business. And really, I think most people looked at that and said, well, that feels a lot more like an asset acquisition than it does a business combination. And this screen allows us to essentially apply that logic to it. It also made a few other improvements. The concept that you can go out and look at whether a market participant can replace a missing element to create the output. They've got rid of that as well, and they've made some other improvements there. So good news for us that they've looked at what we've done and decided to make it a little bit easier to call something an asset acquisition as opposed to a business combination. The next slide, ASU 2016-18, one of the last ones that was issued in 2016. This is a statement that changes how a lot of companies will report restricted cash on the statement of cash flow. And I think there was mixed practice before where we had restricted cash on the balance sheet and in the cash flow statement. I think most companies actually would have classified restricted cash as another type of an investment, either in operating or in investing activities, depending on the nature of the restriction and why it was restricted. And the FASB has come along and said, no, we want you to include that restricted cash balance in with your opening cash balance and reconcile to the restricted cash balance at the end of the year as well, so that there won't be a separate line item either in operating or investing describing restricted cash. What this likely will mean too is we'll have to put a little bit of reconciliation either in the footnotes or at the bottom of the cash flow statement to reconcile back up to the face of the balance sheet, because we'll continue to have restricted cash flow separately presented on the balance sheet. So once again, they're trying to make it easier and more consistent with the presentation of the cash flow. Continuing on with the theme of the cash flow statement, they also came out with ASU 2016-15 last year, and there was several types of transactions that had been out there where there wasn't any guidance in the accounting text on exactly how do you account for certain types of cost. And so there was a divergence in practice on some of these items here below. So they came out with some specific transaction guidance. And then also the last bullet point there had introduced a concept called the predominance principle, where it says if you have a cash flow that has two or three types of different elements on what you're paying, the largest amount of the cash that is going out is going to be the one that we look at to decide where to classify it on the cash flow statement. So if I could just go through this, a few of these for a second. The debt extinguishment cost is all going to be in financing activities, even if you have some kind of sweetener or kicker in order to get the debt extinguished earlier. Some people would put those in operating, but now all that's going to be in financing activities. And zero coupon debt, which is relatively rare for our smaller companies, but having a debt that is significantly below effective interest rate is not that uncommon. And if you had a zero coupon debt, at least the description of the payment that's being made, the entire amount of payment would look like it goes to principal because the interest rate is at 0 or a de minimis rate. So some people would put that all in financing activities, and other people would say, no, even though it's stated at a 0 coupon, we know some component of what we're paying out is really interest expense, and we should put the interest expense in operating activities. And that's how the FASB wants. So they want you to take the effective portion of what you're paying for interest, put that in the cash flow from operations, and the rest of it in cash flow from financing activities. Contingent purchase price consideration, as everyone knows, we set up a liability for a contingent purchase price now when we do a business combination. That contingent purchase price additional consideration is an estimate, and with most estimates, the actual amount that you pay out is often different than what you initially estimated. So the FASB has concluded the way that we should account for that is whatever was originally accrued as your obligation for contingent purchase price consideration, that cash outflow will go as an investment activity, and the cash flow that's in excess of that would be shown as operating cash flow. And then I'll just mention one other one here, and that's the distributions from equity method investees. There was no clear way to account for an equity method distribution, particularly when your investment account is reached or approaching 0. And they are allowing two methods to account for cash flow from the equity method investee. The first one is if you are receiving distributions in excess of your basis, you're going to put those as investing activities, and a return on your investment you're going to put in the cash flow from operations. The second way that they're going to allow us to do it is to use a look-through method, where if you know the distribution came from the equity method investee because they sold an asset, or they're going through some kind of liquidation or had a major gain, then we can look through our company to the equity method investee and account for the cash flow in a manner similar to what the equity method investee would account for. I think that would be harder to apply because that may happen in one particular year, but it would be harder to know on each distribution exactly what has caused that distribution, unless your distributions are pretty limited from the equity method investee. Okay. Moving on, accounting for credit losses. And, obviously if you're in a bank or a financial institution, this ASU is a major pronouncement for you that requires some time to implement and to figure out. But I think for the rest of us who don't do a lot of financial institutions or a lot of banking, you would look at the title of that and just move on and be done. But I wanted to bring it up that this does apply to trade receivables and lease receivables. And if you're a lessor now, all the leases are going to be on the balance sheet, so you have a lease receivable or trade receivable. And I think most people are probably doing a method that would be consistent with what this statement says. But now we officially must use, kind of a matrix approach where we're going to estimate the amount of our credit losses at the time we get the receivable generated. We're going to accrue credit loss. And so using an AR aging bucket, having that set up where you have a certain amount over 90, maybe you reserve 50% of that or 25% of that, reserve 75% over 180, 100% over 360, something like that is going to be the way that is required to account for credit losses for trade receivables. And the only difference is, in theory, we should have an amount on current receivables, even if it's a small amount. Obviously, materiality always comes into play, and so there may be an argument to say, well, we theoretically should have something there, but maybe it's not a very material amount. But that's has to be determined on a case-by-case basis. Okay, we're going to do our next polling question.
Correct. Question number 2, accounting for credit losses applies to, please select one. A, trade receivables, B, lease receivables, C, both.
I think it's important to remind people too, you don't have to get these questions right. You just have to answer them. So obviously, we want to make sure you're participating, but certainly if any of these questions lead you to have a comment, just please type it and we'll try to get those answered. Okay. ASU 2016-09 is another one that is intended to make our life a little bit easier. And these were improvements to accounting for employee share-based compensation. And the concept here is the original accounting that existed was if a shareholder exercises an option and the company gets a tax deduction because of that. It really wasn't through anything that the company did itself. So, there's similar to if a shareholder paid off like a litigation settlement on behalf of the company, because the shareholder did it on behalf of the company, it would get recorded on the books of the company. Similar, kind of the opposite theory here is, well, the company didn't really do anything to generate this benefit, so really it was like the shareholder had given the benefit to the company. And so we would be required to take some of these tax benefits from exercise of stock options and record them to additional paid-in capital. And you have to kind of keep track of this APIC pool, knowing when it's been generated and when it's being relieved. And it's a very complicated calculation to do. And companies that are in a net operating loss position didn't always keep track of that until some of the stuff flipped, and then they had to go back multiple years and try to figure it out. Very difficult to implement in practice, even though it was more correct theoretically. So now what they're going to allow us to do is record all excess tax benefits, tax deficiencies, straight to our income statement as a discrete item in the period in which they occurred, as opposed to worrying about the APIC pool, which is going to be really helpful to a lot of companies out there. The other one that we had that used to drive a lot of us crazy was you used to be able to only withhold the minimum amount of tax before potentially creating some kind of liability type of award for a cash-settled stock compensation. And a lot of executives would rather have their maximum statutory amount withheld because they're in a high tax bracket, and just make their life easier and the company's life easier to have the actual taxes they think they're going to owe withheld as opposed to just the minimum withheld, which unfortunately used to create an accounting issue for us because of that excess amount we would be considered a cash settled award. So now they've changed that and have allowed us to permit withholding up to the maximum statutory rate before we would have to consider that a cash settled award. So that's also an improvement there. And then 2016-09 also makes a few other improvements. I was going to mention the implementation date on a lot of these things. The effective date is different between private companies and public companies, and some of them are effective Q1 and some at year end. And instead of spending a lot of time going through each one of these as the effective date, I'll just email out the effective dates to everyone who's on this webinar when we're done, a schedule that shows you what all these effective dates are. I once had a chance to talk to the Financial Accounting Foundation who funds and oversees the FASB, and they asked me, one of the things they ask is, well, how can we make these things easier for you? And I said, well, why don't you start by making every effective date the exact same for every single standard that you issue? And they didn't take my advice, because the effective dates sometimes roll in at the end of the year, sometimes roll in Q1. Oftentimes are different for public and private, things like that. So I'll go ahead and get that sent out when we're done here. 2016-03. This is a bit of a technicality that they changed to solve a problem. And the problem is, if you have a new accounting pronouncement, a private company accounting pronouncement, you had an effective date and you could adopt it on that effective date. If you chose not to adopt that on that effective date, either because you didn't think you needed to or didn't want to, or if you're a private company, maybe you didn't even know it had been issued. If you're not getting audits done every year or whatever, you may not even have known that private company was issued. And so the private company exemptions, there's about 5 or 6 of those out there, dealing with goodwill, VIEs and related party real estate transactions, fair value cash flow hedges, things like that allow private companies to adopt and transition or adopt a method that is less complicated and easier to apply than what public companies need to adopt. Well, the problem is, if you didn't adopt that on its actual effective date, you would need a preferability letter, or you'd have to consider whether the private company council pronouncement was preferable over your current accounting. And you could probably theoretically never get there on that. And therefore, in theory, it would be very difficult, if not impossible, to adopt a private company council regulation after its effective date. I'm sure people had done it anyways. So to fix that problem, what they did is they just took away all effective dates in the private company council, the PCC accounting standards. So now you can adopt it. The effect of that was allowing you to adopt that on any given day. Okay. We have a question?
We do. Kevin asks, for contingent considerations earn out, if it is almost a certainty, would you include it in the purchase price, such as an earnout with a low threshold of EBITDA that lasts 3 years post-transaction?
Yeah, so I think if on the initial accounting for the business combination, you make your best estimate of what the purchase price contingent consideration is, including earnout, and you record that as a liability. And then this new accounting guidance says when you settle that liability that you had accrued, if you settle for what you've estimated, you put that in investing activities. And if you settle for more than that, it goes into operating activities. So hopefully that answers that question.
Great. Thank you.
Okay. Moving along. The next one also is, it makes it easier to apply deferred taxes. Historically, if you record a deferred tax asset or deferred tax liability, the criteria that would generate the decision whether you record that as a current asset, current deferred tax asset, or current deferred tax liability versus long term was based on the underlying nature of the attribute that generated that book tax timing difference. So if you had a timing difference related to an AR allowance, it would be a current deferred tax item. If you had something that related to property, plant, and equipment, that would be a long-term deferred tax asset. And that didn't make a whole lot of sense when you think about how deferred tax assets and liabilities flip into current, because you have NOLs out there you may use, your position next year in terms of how your actual tax cash outflows may be, often doesn't flip in accordance with the underlying nature of the account that generated the deferred tax asset or liability. So to make it easier, they just said, okay, all of our deferred tax assets, if you record one, or our deferred tax liabilities are going to be recorded as long-term, non-current on the balance sheet. So once again, a little bit easier to implement there as well. Okay. 2015-16, once again, another simplification of the accounting rules. And in a business combination, I think everyone knows you're allowed a 1-year true-up period to record what you think is the allocation to your fixed assets, long-term assets, intangibles, et cetera, because you often don't know everything when you close the deal. You have some provisional liabilities. Maybe you need some time to assess what they are, et cetera. And originally, what would happen is you'd say, okay, well, in the third quarter I fixed it, and then when the next year rolled around, you have to show that as if you had implemented it in Q1, Q2, and Q3, and kind of show it as a retroactive adjustment to the previously presented financial statements. And this is just making it easier to say, okay, in the period in which you determine that you need to make an adjustment to the provisional amounts, you true it up in that period. So you would true up, a revision to depreciation expense if you change your property, plant, and equipment in Q3 or Q2, whatever the period is that you've trued it up, and record it all then, and not worry about having to go back and recast your prior interim financial statements. Okay. ASU 2015-05. Just wanted to bring this up and talk about it for a minute, because it's one of those rules that I think most of us probably don't like, and if they had asked us our opinion, we would have said, don't do it this way, but they didn't, so this is what we have. And the question is, if you adopt an online cloud-based software package, say NetSuite or something along those lines, where you don't actually own the software, it's not sitting on a server, but it's sitting out there on the cloud. The question is, the fees that you paid to do that and the costs that you've incurred to implement that, should it be accounted like a software license? Historically, we would capitalize those types of costs, or should you expense it? Because what you really have is a service contract. You don't actually own any IP or own any asset if you have a cloud-based system. And so what 2015-05 said is, if you don't have the underlying software license, which I think would be pretty rare for you to do, for you to actually own, then you have to expense it as a service contract. And it kind of feels a little bit unjust, because it feels like whether I host the software on the cloud or if I host the software on a server, the accounting ought to be similar. But it's not, unfortunately. So if you don't own the software, you don't have a license to the software, you couldn't move it from one provider to another provider, then it would be expense as is incurred. And even if you did capitalize it, oftentimes these are 1-year contracts or 2-year contracts, and your amortization period would have been 1 year anyways if you had really gone back and looked at it, as opposed to your typical software where you say, okay, I own it, and now I'm questioning how long am I going to actually run this software. I'll probably run it 3 years or 5 years or whatever it is, and depreciate it off. So I think this is one that's out there that has ramifications that are increasing, and most people may not be aware of it, so I just wanted to bring it to everyone's attention. Okay, we have another question.
We have another question. Question is, do you see the small/private company option to classify all excess purchase price as goodwill a way to avoid the cost in time, money, and other resources needed to perform evaluation of CRIs?
Yeah, I do think that's the case, and I think that's why the Private Company Council gave us that exemption. I think it's a much more practical based approach, and is a way to save a lot of time, money, aggravation, expense of hiring valuation experts, expense of making sure you're challenging their conclusions and analysis and the like, and certainly a lot easier just to account for it in accordance with the Private Company Council. Okay. Moving along, another pleasant topic, going concern disclosures. Historically, this has all just been in the accounting literature and the gas private company auditing literature, as well as the PCOB auditing literature. and there is nothing in GAAP that talks about going concern. So the FASB looks at this and says, well, that doesn't really make sense. I mean, really, it's up to our preparers to disclose, kind of risk and uncertainties to their users. And if there's a going concern issue, it ought to be driven by the accounting rules as much as the auditing rules. So they came up with an accounting standard to talk about going concern. So this would be required. We're talking about required disclosures in the footnotes as opposed to disclosure that's in the audit opinion. And it puts the onus on the companies to determine if there is doubt about an entity, about their ability to continue as a going concern. It puts companies in an interesting perspective because most companies are very optimistic. I mean, they strongly believe in what they're doing because if they didn't, why would they be there, particularly if it's an entrepreneurial type business. There's always a risk of not succeeding. There's always challenges to be out there. And most companies would have a hard time saying, we think it's probable we're not going to survive. Because if you did that, you wouldn't even go into business to start with, But nonetheless, we're required to look at that now as companies, not just auditors. And it does use that threshold of probable, which is different than what the auditing guidance says. The auditing guidance doesn't have the word threshold. It just says if there is substantial doubt about your ability to continue as a going concern, we have to add a paragraph. And substantial doubt, at least in my mind, is not a threshold of probable. It's somewhere probably south of probable, less stringent than probable. So you have a higher threshold to look at. Is it probable we're going to go out of business? Well, if you just go back to my example, even if the guy's optimistic or the lady's optimistic who's run the business that we're going to be just fine, you could get there probably pretty easily if you had your bank debt coming due and you weren't sure you're going to be able to renegotiate it, or you had a major event where you lost a lot of money in litigation or something like that. So you have this threshold of probable, which is higher than what the accounting standards have. But you also have a longer time frame to look at it compared to what the auditing standards have. The auditing standards are 1 year from the balance sheet date. So if we issued an audit opinion in October or November, in theory, we'd only have to look to see that you can make it through that December. So you have to say, okay, can they make it 2 more months or 1 more month or whatever, in theory, as opposed to a whole nother year. Now that was actually interpreted and implemented differently by different people. I mean, certainly, you issue an audit opinion in October and their bank debt's coming due on January 2nd, you probably would get there on a going concern anyways, based on that threshold. But, in theory, some people would say, well, we're not going to hold our clients to a higher standard than everybody else or what the standards say. So we look at a 1 year from the balance sheet date. So in this case, you have a higher threshold, but you have a longer period of time to look at it. And it also prevents, sometimes we would not issue an audit opinion to the end of the year because of going concern type of questions, and that won't be possible any longer. We'll have to always be looking 12 months out. There's often a question here that people give me in what's going on with the accounting standard or the auditing standards with this as well. And the auditing standards on gas, it's going to be revised to say if the underlying basis of accounting has guidance on going concern, you follow that. And if it doesn't, then you follow what we did before. So if you are doing a tax basis audit or an audit for the small and medium-sized enterprises underneath the financial reporting framework, another basis of accounting, you would continue to follow the old auditing guidance. And if you're doing an audit underneath U.S. GAAP, you're going to follow this accounting guidance. Okay.
All right, we have polling question number 3. 2 main changes from the ASU 2014-15 audit guidance are A, requires assessment for a year from date financial statements are issued or available to be issued. B, uses the threshold of probable. C, full.
Okay. See what happens in the results here. Yep. Good. I feel like we need a little Jeopardy music, but that's being answered. Okay. I'm going to move into the two major standards here that we have to adopt. And we got about 15 minutes to get through this, which is not very much time considering how all-encompassing these standards are. They've taken over 10 years to develop. This was the initial drive with the IFRS to say, okay, we're going to converge our standards and try to have our accounting rules that are as close to the same as we can. And they were relatively successful in achieving that with revenue standard and with the lease standard, but not perfectly aligned. And so in any event, 10 years to develop and thousands of pages of guidance and interpretive guidance and background information can't really be covered very well in 15 minutes, but I'm going to do my best here. And so we'll go through leases first. Let's see here, make sure we got the right order. There we go. So a lease is a contract that conveys the right to control the use of an identified asset for a period of time and consideration. And so now we're going to ask you another polling question, and that's going to be, what's the definition of a lease? So I can reread it again as you're looking at it. It's a contract that conveys the right to control the use of an asset, of an identified asset for a period of time in exchange for consideration. So we'll give some people some time to type some semblance of that out. And since we have to answer 75% of the polling questions, we'll just give it a little bit of a time here. Okay. Hopefully everyone has time to type something in there. The interesting thing on leases now is they're all going to be recorded on the balance sheet. So we can get to, there we go. This is underneath U.S. GAAP. It's different for IFRS, but underneath U.S. GAAP, they're going to be broken into two types of leases that are on the balance sheet, either a financing lease or an operating lease. And the difference is how that lease gets amortized through the P&L and through the cash flow statement. The reason it's different from IFRS is IFRS really, they put all leases on the balance sheet. They're converged on that concept, but they take them all off the balance sheet, similar to a financing lease. So what we're going to do is we're going to record on the balance sheet a right of use asset, and we're going to record our lease liability. This is for any lease that is in excess of 12 months. If you have a lease that's 12 months and has no option to purchase it, or you have an option that you're reasonably certain not to exercise it, to extend and not purchase it, then you would account for these leases on your balance sheet. So they're all going to go on, and then the question is, how do you amortize them off? And what we're going to do is on our operating lease, flip the slide there. Yep. Our operating lease, they're going to come off on a single line, and a generally straight line as lease expense. And then your financing leases are going to come off in a way that's very similar to what your current capital leases are. You have a question?
We have a question. Regarding operating leases, for an additional assets added, do we assume impairment after day one, or do we calculate impairment as of day zero and carry through beginning retained earnings?
I'm not sure I entirely understand that question. So if we're, when we put the operating lease on the balance sheet that wasn't there before, you are allowed to put it on from that, the amount of lease obligations that are owed from that point forward. So you don't have to go back and calculate your historical amount there and adjust your retained earnings. That's a modified transition that's allowed. Then once that is once you calculate that and put it on the balance sheet, if you're no longer using that leased asset, or it's not generating the cash flows that you thought it was going to generate when you entered into the lease, and your forecast doesn't support it, you would have to take a day one impairment, and that would go through your P&L as opposed to your retained earnings, I believe. I mean, I just think that's, the analysis of that is from that point forward, not going back in time. And if we could too, I'm going to switch over here and show you guys an example of this. It's a little easier to follow through as opposed to just talking about it in theory. So I've created a lease example that's going to show you the difference between a financing lease and an operating lease, and how that gets amortized off over time and what that looks like. Whoops. Okay, I'm coming. Okay, so on this first screen here, we're looking at the typical type of a lease arrangement where we have some cash rent. It's going up slightly, $500 in first year, $515, $530 the third year. So then you would record that on your balance sheet either way, on either operating or capital lease, using your effective borrowing rate. And so we discounted that back to $1.4 million. That's the 5% discount off that stream of cash flow there. And then obviously our straight line, if we just straight line that expense, would be $515. So we flip the tab 2 there. Yep. So if you were doing a financing lease, this is what it would look like. You'd start with that lease obligation of $1.4 million, and then the first year, we're assuming that we're going to make the payments at the end of the year just for simplicity's sake here. You're going to record $70,000 of interest, $500,000 of principal reduction. Then in year 2, $48,000 in interest, $515 in principal reduction, etc. Now we need this schedule now. Even though our operating leases are coming off on a straight line basis, you need to calculate this out in order to know how to come up with the straight line expense that you're going to have, and I'll show you that here in a second. So beginning of year 1, if you flip to the third tab, that's what's being set up. In general, this is a simplistic example. You could have some initial direct costs and things like that, but ignoring all that, this is what would be set up on day 1 underneath either scenario. And then we look at the end of year 1. On the left is the operating lease, and so I said we got to get to that straight line expense of $515. That's that amount there on E21 highlighted in red, because we want to have the straight line expense over all 3 years. So how do we do that? Well, we know we got to get that lease obligation amortized off on the effective rate. So we know what the $70,057 is from the amortization schedule that we did before. If it's off to the right here on the financing lease, we call that amortization expense. And then we're going to depreciate our right-of-use asset. The $444,943 is, for lack of a better word, it's a plug number to get you to the 515. And it's kind of crazy that you have to do that, but there's no other way to get to the 515. So it's a balancing amount to get to the 515. So it become more clear on the next page when we go to end of year 2. You see that again here, our amortization of the lease obligation is now $48,560. That would be interest expense if it was a financing lease. Lease expense is an operating lease. Then to get to 515, we have to add $466,440 to it. It gets to our straight line expense. And then if you go to year 3, you'll see it again. That the depreciation of the right-of-use asset is now $489. So we flip to the total tab. We look at it and say the crazy part about this is when we're amortizing that right-of-use asset, it's like reverse acceleration, you know. So we take the least amount of amortization in year 1, we take more in year 2, and we take the most amount of amortization off that asset in year 3, which is a little bit of a quirky outcome. And the FASB acknowledges that as much in their basis for conclusion. But essentially, this was a compromised position that they adopted to allow, try to get consensus around putting these assets and liabilities on the balance sheet. So you can see there, this is how it amortizes off. So 1.4 million less the 444, 466, and 49 would equal 0. You'd have your right-of-use asset amortized off your balance sheet, just not on a straight line basis. The other unique part of this is on your cash flow statement. If you were doing a financing lease, if we go back to end of year 1 tab, if you're doing your financing lease, in your operations, cash flow from operations would only be the interest expense, and the payment going out would be a financing expense. Where if we're doing a operating lease, the entire 515 is going to come out of our cash flow from operations, similar to what it is today. And then obviously on the EBITDA too, if you had an EBITDA calculation, your interest expense is an add back to EBITDA. Lease expense typically is not. So it's an interesting question here. I mean, most of our lives, people would rather have an operating lease than a financing lease because they want to keep this liability off the balance sheet. Well, now it has to go on the balance sheet no matter what. And it almost feels like people might rather have a financing lease than an operating lease because of the cash flow impacts and because of the EBITDA too. So it will be interesting to see how it turns out. I actually think there will be less consternation about determining whether something is an operating lease or a financing lease. The balance sheet impact is pretty consistent between the two. Okay, I've only got a few more minutes left, and it almost feels hypocritical to flip over to revenue and talk about that for a minute. So let's see, flip to this slide over here. Here we go. So revenue recognition, is public companies in first quarter 2018, and they have come up with a few standards here that I've given you to make this easier to implement. But if you have a business that has contracts, has multiple things that you're delivering, warranties, installation, a product, different types of licenses, or you have a product that is being built over time and historically there was or wasn't subject to percentage of completion, something like that. This revenue recognition model is going to take some time to implement, and there's a lot of fear that people are behind the 8 ball on getting this done. If you have a cash-based business where you're like in a retail environment and there's a contemporaneous exchange for the goods or services for cash, maybe this doesn't have as much of an impact. But for a lot of us, it will have an impact. And we could flip through just 2 more slides real quick. So the new model really has 5 steps to it. And it's identifying what the contract first, and then trying to separate out the different performance obligations that you have for that contract, and then allocate the purchase price to those. First determined, then allocated, and then recognize that when that service is being completed or that obligation is satisfied. And it is actually going to, I think that the hardest challenge is we're used to thinking in terms of our current revenue recognition model in our mind as we work through these concepts. And it's going to take us some time to get used to thinking in these steps as opposed to the current revenue recognition model. So Hein has had a couple classes on the revenue standard, and I'm sure we're going to have a couple more here coming up after the financial reporting season is over. And I encourage you to take some of those classes because while this looks simple on this particular graph, you could spend several hours in each one of these boxes talking about the nuances of how you determine what is the contract and identifying the separate performance obligations. And my only takeaway from here is don't underestimate the amount of work it's going to take to adopt this new standard. And if you could flip to the next slide, on top of me sending out the effective dates, here's a link to the FASB website that goes through all the FASB effective dates that you can click on as well. And with that, I think we're in the Q&A session.
We are. So now we would like to give our attendees a chance to ask questions. To ask a question, please submit a question via the chat box on the bottom left corner of your screen. If we don't get to your question during the webinar, our presenter will follow up with you via email.
So the first question is, would you be willing to send out that Excel example for us to use as a reference? Yep, we'll send that out along with the effective date when this is over. Any other questions there?
Well, thank you, Jake. That's all the time we have for now. Attendees, please check your inbox for a follow-up email with an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you for attending and have a great day.
Well, we did it.